You are also muted. So if you would like to speak, you just need to unmute yourself. If you need help, I'll help you. But it's just a little bit easier while we're talking to kind of not talk over each other or anything like that. So my name is Carra Pewsey. I'm the Management Training Director for CMI. We are celebrating 50 years. Laura's lovely background helps remind that. And so we have started, this is our third training video for board members, and what better topic than insurance, especially with some of the upcoming changes, things that are going on in the industry that Larry will talk about later. So that's me, and I will introduce Larry Thompson. I don't know where he is in your squares, but he's right over here for me. And I'll let Larry kind of tell you a little bit about himself. He is with American Family Insurance.
Thanks,
Larry.
Carra. All right, make sure I'm not on mute here. So thanks for the invite tonight. Good to see all your faces. And yeah, like Carra said, my name is Larry Thompson. I'm with American Family Insurance. My office is in Lake Oswego, right off of Boones Ferry Road. And there's 8 of us in the office here, all fully licensed in PNC and very much experts when it comes to association insurance. This is a big portion of our business, and we do a lot of work in this area. So if for some reason we don't answer your question this evening, or if you think of something later, you're always welcome to call the office and inquire. I know CMI leans on us and we lean on them to get solutions, but we're certainly available for anything that comes up with you guys. So I've been doing this for about 25 years, and 24 to be exact. So about 20 years ago is when I started building my relationship with CMI. So I've been working with them for a long time, and know most of the property managers over there. They got some new faces as people are retiring out, so it's good to see. But it's a really nice feature that they offer, or a program that they offer to kind of educate board members, because the educated board members and the educated associations tend to fare better among a number of different categories besides insurance. But insurance can be complex, and understanding the concept of how 2 policies come together and make one coverage. I'll use the old hand signals here. You want your insurances to lace up. And Laura and Carra are probably gonna laugh at me because I use the same hand signals every meeting that we do. But we really like to think of association insurance as kind of a 2-part insurance. One is, what does the association insure? And the other is, what does the unit owner have to insure? And we want to make sure both sides of that fence are really taken care of appropriately to make sure that there's no frustration out there in the marketplace, or if we do have a claim, or when we do have a claim. So this evening, what I was going to talk about is those 2 parts. I was going to briefly talk about the association coverages that you will most commonly see. And I've kind of created a general or fictitious association for us to look at in real world example, or fictitious world example here in this case. And then we're going to talk briefly about what unit owners need to address on their personal insurance, and the questions that they need to be asking their insurance agents, and to get properly structured there. So, but I do want to make this interactive. I don't want to just jabber at you for the next however many minutes. I would love it if you guys stopped me, interrupted me, raised your hand, yelled out. If you have questions and I'm not going down that road to address them, I want to make sure that we certainly get the opportunity to address specifics for you to get you smarter out there on this. So with that, is there any questions right off the bat, or any thoughts? Linda, you're on mute. You're on mute. I can't hear you. You're on mute.
Okay. The biggest question we have is that for at least 12 years, we have never had our insurance coverage reviewed to know that of our 13 buildings, we have an inflation adjustment on our current policy with State Farm, but not knowing how that inflation adjustment is kept pace with reality. How often and when and at what expense, what's the best way to go about having things reassessed to determine if we are insured to the right degree?
Yeah, that's a great question, and that's a big portion of what we were going to discuss tonight on this example. To answer your question directly, generally the bylaws, I think, call out that you should be reviewing your insurance. Some of them say annually, some of them say every 2 years. Okay.
5 years.
So yeah, so if it's been a while, it's certainly something that you probably ought to do as a board. I think the treasurer or the secretary, I believe, is in charge of insurance, according to the bylaws. But anybody who will volunteer to take the time is really the person you grab. Linda, you might be a good person to do that since you've had some experience in the industry. But I would certainly engage in a review. And the second part of your question is really kind of the first thing that I was going to do on the shared screen here, is talking about building valuations and what we're seeing today and what inflation protection riders do versus what calculations do, and what your agent with State Farm or any other carrier should be doing for you as far as the reviewing of how much we need for insurance. So with that, I'll just go ahead and share the screen here, and hopefully that'll further your answer as we go down that road, because it is a really great question, and I want to make sure that we definitely touch on that this evening. So, so the screen that you're seeing right now is a template that actually CMI, it was Patty Woolery back in the day. She was in charge of insurance at CMI, and she actually forced me to use a template. And this template made all of her associations that she worked with a lot more comfortable, because she would not only force me, but she would force my competitors to use a very similar template. And we would all come to the table with this filled out template, and associations could look at it side by side and kind of really get to the nuts and bolts of what is the better coverage here, what is the better value for us, and make it a little bit easier to decipher some of this insurance language. So this is the template of coverage for a fictitious condo association that we have here. The first section is just kind of who we are, the coverage features, how we're rated with AM Best, which is an independent rating company. And then we want to make sure that we're addressing the bylaws and declarations in your governing documents to be compliant with the insurance that we put together for you. But under the property coverage there, you'll see the first section, first line item right there that's in blue, building rateable limit, calculated replacement cost. Sometimes that'll say building limit. And this is really showing you what the association's replacement cost or coverage amount is for all the buildings that you might have cumulatively. So we go through a process when we're writing a new association. We take all the public data, all the details that are available on the buildings that you guys have, and we plug that into a really complex computer program. And that complex computer program gives us a insurance to value or replacement cost calculator score. And it basically says, if the worst case scenario happens tomorrow, what is it going to cost us as the insurance company to replace your property in full with like, kind, and quality? And that is the target amount that you want to be insured for. And that's the target amount that we want to insure you for, because it gives us the ability to identify how much should we be charging this group of this condo association or townhome association for their insurance package. We call it a building rateable limit. And that building rateable limit means that we really just identify that number for rating purposes, because the next line item right below that is a feature that our company and a lot of the other big insurance providing companies out there give you. And that's an endorsement called guaranteed replacement cost, which means that no matter what we insure the buildings for, in this case, $30 million, no matter what it costs us to replace those buildings with like, kind, and quality, we will spend whatever it takes. We guarantee that we will replace the property as it sits before the loss. So that is a feature. Some carriers don't offer that. So you might see a replacement cost guarantee, which is different than guaranteed replacement cost. Replacement cost guarantee can be 100%, which means that they're just going to insure it to 100% of whatever that number above said, or it might be 125%, which gives you an additional 25% of coverage. The really important thing that Linda was hitting on earlier was that once a policy has been in force, most carriers don't go in and recalculate every year. They don't put all the numbers back into the computer system and don't hit recalculate. And they rely on a feature or an endorsement in the policy called inflation protection rider. And an inflation protection rider basically takes a cost of living index and it applies it to the policy and increases it between 2 to 4%. Is kind of the general numbers out there. The problem with that, because it really hasn't been a problem in my past 20 years of being an insurance agent, but the past few years, it has been a problem because what's been happening with inflation? It's been absolutely blowing up here this past year. The year before it was even on the increase, and this next year it's supposed to be the highest ever. So what $30 million bought us for replacement cost 2 years ago is not going to cut it here if something happens today. So most of the claims that we come across aren't really having an issue with this for 2 reasons. Number one, we rarely lose a whole complex or multiple buildings in one fell swoop. It's a very, very small percentage of losses when we have to get to building limits, if you will. The other reason that it doesn't come into play is because we have this highlighted section for guaranteed replacement cost, which means that, hey, we miscalculated, but it doesn't really matter because we got to take care of our clients and rebuild them to like kind of quality. But I will tell you, the insurance companies are getting a little bit anxious about this, or quite anxious. Last year alone in Portland Metro, the cost of labor and materials increased 40% year over year. And so what we're seeing from our end is a standard loss. Let's say a pipe broke inside somebody's kitchen and flooded the kitchen and did some damage there. Something that would normally be, $10,000 is now $14,000. Or if it was $20,000, it's now $28,000 for us to repair it. So we, as an insurance carrier, as an insurance industry, want to make sure that we are collecting the proper amount of premium for the risk we're incurring. And in most cases, with most carriers out there right now, with this drastic inflation in front of us and behind us, we are not. We're actually underinsuring something, not by design, but just because of the inflation protection riders that haven't been performing like they were traditionally. So, Linda, did that help you at all? She's good. Okay, I see a nodding head. Any other questions on that?
No,
Go ahead.
I said, no, I'm fine. That's
Okay.
good.
Yeah, and so what to expect moving forward in that category, because this is going to be a big issue. So with my company, we're actually recalculating, not just applying a inflation protection rider for the next renewals coming up, but we're recalculating 100% of our properties. So what would happen if we had a policy like this in force last year at $30 million? We're going to hit reset or recalc on the computer here, and it's going to give us a fresh number, probably closer to $40 million at renewal. So what does that do to the premium with insurance policies, right? The question on that would be, we're actually increasing the amount of coverage by 25% in this example. So the industry or we charge by how many thousands of dollars that we provide. So we can see things like increases in premium due to a higher TIV or total insurable value or replacement costs on the buildings out there. Our company is taking a pretty proactive approach and not just recalculating and increasing the replacement cost to the appropriate level, but we're actually capping kind of some premium increases that we're going to be seeing due to that. So instead of sending you out a bill for 25% higher than we were last year, they might be capping it at 15% or 10% or 20%. We're just getting more information on that. And again, I want to keep this generalized because Linda's group's with State Farm. Rebecca might be with a different company. Susan's board might have insurance with a different carrier. So this is kind of general talk here. But most insurance companies don't want to create a shopping event, which means that they don't want to give you a giant increase on your cost of insurance and force you to go shopping, because we want to keep the business on the books, but we do want to do it appropriately. And we want to, our company wants to make 1 penny out of every dollar that we bring in as a profit margin. And if we can't do that, we got to increase costs of insurance in those cases. So of the group that's on the phone here, who's seen insurance increases over the past year or so, 2 years? I know Laura and Carra have seen their fair share, but yeah, Rebecca, you've seen some increases. And I think that's going to be a common endeavor for the next 2 or 3 years. I don't think that's going to even out very quickly. The insurance companies are very much behind the 8 ball on not collecting the correct amount of premium, and especially in the Portland Metro where it's so darn expensive to rebuild and repair. So kind of moving down the line here, community personal property is a category for association property that's not considered building. So you would have things like a community room that has furnishings, a ping pong table, weightlifting equipment, pool chairs, pool equipment, a pool table. All those items would be considered community personal property. Sewer backup is a line item. Portland, we don't have too much of an issue for newer properties. This is a big issue in the Midwest where we have a lot of basements, but it can be applicable out here. Sewer backup is defined as affluent coming through the sewer lines or the waste lines of the property and entering the premises from a cause off property. So if down at the street corner on the street, your sewer interchange has a malfunction and the whole building has a backup in it for affluent from the sewage system, that would be classified as a sewer backup claim or a sewer backup peril. And in that case, sewer backup has a limited amount of coverage that it will provide. In our case, we show $300,000 per building on that. There are other options available. But generally, the largest claim that we've had out here in 24 years with my company is $124,000 for a sewer backup loss. If you have a sewer backup or affluent backup due to a cause on property, so if you have a sewer main line inside the building or a toilet overflow or something gets clogged up and there's affluent coming back into the property and causing damage, then that is actually considered a plumbing loss, and we actually pay for that without limitation. And most carriers kind of use the same definitions along these lines. So the important thing to remember on sewer backup is we don't pay for, the insurance company does not pay for the repair. It pays for the damage resulting. And so if you have that backup, we're not going to snake out your lines. We're not going to repair the collapsed, sewage line that broke down, but we will pay for the resulting damage thereof. So boiler machinery and mechanical breakdown. This isn't super common unless you live in a mid-rise or a high-rise building. Things like elevators, communication equipment, boilers, things that are kind of common services for the building would be included under this. for the breakdown of those particular items. Elevators are kind of a dead giveaway. If there's an elevator in the building, we generally will add this particular coverage. This example that I created is more of a campus style property out in Beaverton, if you will, where there's multiple buildings, lots of units on that with no elevators, not exceeding 2 stories. So. And then the next line item that I always like to kind of point out here is, what does the association's policy cover? What specific part of the building does it cover? And it can vary depending on the unit or the association that you're with. With the industry, our policies all say something to the effect that we insure the insured's property. It doesn't go on to say that we insure the shell of the building, or the siding, or the roof, or the doors, or the windows. It doesn't kind of break things down into a level like that. It just says we insure the insured's property. And there's an endorsement at the end of the policy that says we get our definition of the insured's property from your governing documents. So we use your governing documents, and in most cases, it's in your bylaws, usually Articles 7, 8, or 9 of your bylaws, that actually shows a section on insurance. And so this is an example of an association that Carra is familiar with. But this particular example has an Article 9 insurance. And I usually, with my trained eye now, I go to 9.1.1. And I'm going to look for what the association is required to insure. And so this particular association is insurance covering the loss or damage under a replacement cost policy for a whole bunch of other legal languages. And I'm looking for this little term right here that's highlighted. So this particular one is saying the association has to insure full insurable replacement costs of the units and the common elements. All right. So in my mind, I immediately know that this particular association is what we term or what we call all-inclusive. And what that means is that this particular association not only insures the shell of the building, which everybody always agrees on, but it also insures the units. And that includes the drywall, the paint, the floor coverings, the cabinetry, and the fixtures inside everybody's unit. And then I'll use my little hand signals here again, but the best visual I can give you on this is if you could take your condo unit in your hand and you take the roof off of the unit, you turn it upside down and you give it a gentle shake, anything that falls out, you personally have to insure as a unit owner. If it stayed in there, it's considered part of the building and it is technically insured by the association's master policy. About 95% of associations in the state of Oregon, at least, have this kind of verbiage in their governing documents. There are a few that are studs out, but the vast majority are what we call all-inclusive coverage, or walls-in coverage is what another terminology that the mortgage industry uses for that. Any questions on that right now? That's usually a pretty good concept to make sure. And I'll tell you that 95% of associations have all-inclusive coverage. And I will tell you about 15% of association unit owners understand that concept. A vast majority of unit owners say, well, I think we're supposed to insure, that I'm responsible for my unit, so I'm going to get insurance on my unit. Or their insurance agents told them that condo insurance, the association covers the studs out and you're supposed to cover the, the drywall in. That is poor coaching on my industry's behalf. And if anybody is worth their salt in associations or condo units, they'll understand this concept pretty well. So, any questions in regards to all-inclusive? All right.
Yeah, actually, sorry, Larry. So if a building has all-inclusive coverage, what kind of coverage should each individual owner get?
Yeah, that's a great question. So I'm going to reserve the second half of this kind of session to talking about what the unit owner's insurance should look like and how that would work. So I'm going to specifically answer that in depth, but I want you to make sure you you catch me when we do that and make sure I answered all your questions, because I think it'll all come together for you here in a second on
Okay.
that. That's a great question. So while I just told you that this particular example is all inclusive, which means that they're not only going to insure, the shell of the building, but the units, that's not technically true, because the association does carry a deductible. Now, the deductible in this particular scenario is kind of the normal, or what used to be a very standard deductible, which is $10,000. So the first $10,000 of a loss to the building or a unit is not covered by the association's master policy. It is therefore covered by whom? Anybody have a guess on that one? I know Carra knows it, Laura knows it, all these pseudo experts. Anybody want to throw out a guess on who pays that 10 grand? Is it the association?
Oh, we're just anxious to pay that.
Yeah.
It
The answer-
depends, Larry.
It can be. In a very small percentage of time, the association can, or they can opt to do that. But the general format for that is the unit owner that was affected in the loss would pay for the $10,000 deductible in this scenario. Okay. So I'm just going to use an example here. I love pipes breaking because that's our most common claim. We get those every week. Let's say a pipe broke in Rebecca's unit and it flooded her kitchen and her living room a little bit, did floor damage, cabinetry damage, drywall damage, the whole works. And the estimated replacement cost or mitigation cost on that thing was going to be about $30,000. So if her policy, if her master association policy looked like this, the first $10,000 of that damage would be paid for by Rebecca, who would in turn take that outstanding $10,000 bill and give it to her unit owner's insurance company, and they would pay that for her, less her personal deductible. Once that $10,000 mark has been met, then the association policy picks up and pays from $10,001 all the way up to the $30,000 that it took to replace and get her unit fixed to correct standards. If there's multiple units that were damaged by Rebecca's pipe break, so not only her unit, but the unit below her, if she's on an upper floor, if both of those units were damaged, then those two units would share in that $10,000 deductible per their percentage of loss. So if Rebecca's unit sustained 20% of the damages and the unit owner down below sustained 80%, because gravity's awesome, then Rebecca would be responsible for $2,000 of the bill, and the unit owner down below would be responsible for $8,000. Again, if their insurance is structured correctly, which hopefully it is, they get to turn around and give those bills to their insurance carrier to offset the vast majority of that cost. But how do you think the unit owner down below feels in that scenario? So Laura knows how they feel. They feel frustrated is what they feel, because they're like, what do you mean? It wasn't even my pipe that broke, and I'm just the unlucky recipient of all this water raining down into my unit and ruining all my property. And I like to chalk that up as a little tongue in cheek here, but I like to say that's the magic of community living. That is the standard protocol and the standard way that association deductibles are addressed in those scenarios. And then Carra kind of alluded to a scenario where sometimes the association does have to pay some of the deductible or all of the deductible. We got a claim this morning with the big snowstorm, the Snowmageddon of April 2022 that we got today. We actually had a tree come down on the top of an association building. And it didn't damage any units. It just took out the roof or put a big hole in the roof. That's what it did. And in that case, since it was common elements and there wasn't a specific unit that was associated with the damage, then the association can opt to pay for the $10,000 to pay for the deductible. And then they have two options. They can either just chalk it up as operating costs and expenses for a loss that they had this year, or if money's tight, then they can turn around and assess all the unit owners in the association or all the unit owners in the building that tree hit, their portion of that $10,000 deductible. And the unit owners in that building would then have to share in that $10,000 deductible or in the whole association, depending on how they decided to do that. And they can turn around as a unit owner and give that bill to their insurance company and activate loss assessment coverage, which should be on everybody's insurance policy in a condo unit scenario. And again, this will make a little bit more sense when I flip over to the condo unit insurance and show you these on paper here, but just giving you the idea of how that might work.
Larry, we have a question from Catherine.
Perfect.
Yeah, hi. All of them. Okay, so you said about 95% of condos in Oregon are the all-inclusive insurance.
Yes.
But I understand ours is in the 5%. So I'm just curious how that's decided and if there's benefits one way or the other.
Yeah, so we have a lot of conversation. If you are in one of those associations that has what we call studs out coverage or unfinished walls out coverage, which one is better, all inclusive or studs out? And the answer is whatever one the association understands and the unit owner understands, and they have that appropriate insurance. Because while all-inclusive coverage gives you two policies that are laced up, the same concept really applies to studs out coverage. So if it's just studs out coverage for the association, then the unit owner needs to carry a little bit more insurance. So if they do that, then that's absolutely fine. If they don't have any insurance or limited insurance, then the association, we could see a big gap in coverages where something's not paid for. That's really the only risk that I see with studs out coverage, is that you're putting more onus on the unit owner to have more insurance, more appropriate insurance. And if that's not executed correctly as a unit owner, then there can be deficiency. And then we have a situation where there's something that's not insured. And you can have a very frustrating future based off of that. There is ways to take studs out insurance and create bylaw language that will make it then all inclusive. There's two ways to do it. Number one, and the most common way, if your bylaws specifically state you are studs out, you would have to vote and get 75% of your vote, if I'm correct. Carra and Laura, you guys probably know that number. You'd have to get a vote to change or amend your bylaws. You make an amendment to your bylaws saying, hey, this is our old insurance scope, this is our new one, this is what we voted on, and we all decided, or 75% of us decided to make the change. And some bylaws aren't written very clearly too, so some of them are a little bit vague. If you have vague bylaws, then you can execute what's called an insurance resolution. And an insurance resolution can be board initiated. It doesn't have to be voted on. It can be a clarifying document on what the association's responsible for, how they handle claims, who's responsible for these deductibles that we just kind of went through some examples on, and how this should all play out. So both very good tools. The resolutions less expensive, less painful because you don't have to get a vote, and very useful. So I highly recommend almost all associations explore resolutions. And then the amendment would just be a discussion on, how do we want to approach this, and making sure that unit owners understand what they have.
So two things, Larry. One, every association is slightly different on their percentage for requiring a
Thank you.
bylaw vote. Some are majority, some are 75%, just depends on your legal documents.
Perfect.
Most of the way towards the end of the documents typically tell you there's a section called amendments. That will be exactly where we can find out what percentage is required. And then the second thing is in terms of which one should you do, depends on your documents. And that's going to be something that your legal counsel is going to be the best person to advise on which step you need to take, whether the bylaw amendment is needed or whether you can get away with doing an insurance resolution.
Awesome. Thank you for clarifying, Carra. So I always tell association members that there's 3 sections of your bylaws that you should really know. And number 1 is, what do you own? What did you just buy into? Number 2 is, what do you have to maintain? And then number 3, what do you have to insure? And the reason that those 3 are so important is because they can contradict each other and oftentimes do throughout. So when we're talking about what do you have to insure, I just told you that this association is all-inclusive coverage or walls-in coverage. The maintenance section of that is going to contradict that all over the place. It's going to say, hey, if you break your drywall by moving some furniture inside your unit and you bust a hole in it, it is going to be your responsibility to repair that drywall. It's not the association's, even though the association technically insures the drywall in that. So I'm an expert on the association bylaws, and when I'm not, I always lean on association attorneys that Carra works with, and Laura and all the team there at CMI work with. And we have a whole team of attorneys that help us with this as well. You know, Carra and Laura and the team are very much experts when it comes to the maintenance section, and they work with attorneys in there, and she's an expert on the amendments and those things. So that's good information to kind of keep in your back pocket. But because you'll get a lot of feedback from your unit owners when you go back to them and you find that insurance section, and you're going to say, oh, this is all inclusive. This is what Larry was talking about, or this is studs out. You're going to have somebody that says, no, 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 you're wrong. I've read it right here in section 8, and they're looking at the maintenance section of the policy. It's not the section that we abide by on the insurance side of things. So just understand those sections are really differing in a lot of cases. So earthquake insurance. Earthquake is a big
Oh,
issue.
Larry, before you move on to earthquake, I got
Yeah.
a question in the comments I want to read. Who determines the percentage shared of damage to the units? I'm guessing the insurance company.
That's correct. Yes. So our adjusters and your unit owner's adjuster will work together to identify the total amount of loss with multiple units. And then they'll break that down as a percentage to give back to the unit owners to say, hey, your unit sustained 31% of the damage and the other unit sustained the rest. And therefore they'll work with kind of the master policy adjuster will work with the unit owners adjusters and kind of identify those numbers behind the scenes to make sure things get paid for. Great question. Any other questions there? Perfect.
I think I would just follow that up with the question to the managers and the insurance. Is there any benefit to the HOA of having the studs out?
Yes and no. You know, a lot of it comes down to who's going to pay the premium, right? If your studs out, then a lot of the premium is paid almost split, depending on how much coverage each individual unit owner wants to get. Whereas if you're all in, it's a little bit more on the association, a little bit less on the unit owner. So, you know, there are pros and cons to both. Oddly enough, Larry and I had this discussion with an association a week ago, and you know, they're gonna pursue all in because they like the idea that the association had more coverage. So in the event of a loss, the association could guarantee that the unit could be repaired, and it wouldn't affect any of the other units by remaining unrepaired.
All right, thank you.
Yeah, the studs out is going to be less expensive premium because you're insuring less of the building for the association. But then the bill ends up landing in the unit owner's lap because they have to increase their insurance level. The other benefit of having studs out is that the association doesn't get involved. You know, the unit owner has a pipe break inside their unit and floods their unit. It's on them. Go fix it, guys. I mean, you don't have to get the board involved. You don't have to get CMI's team involved on administering these things and kind of walking through that process. So there's pros and cons to each side. I think the pros, in my opinion, outweigh on the all-inclusive side just because of the certainty that the association is insured fully. You know, regardless of what the unit owner has. Worst case scenario, a unit owner has no insurance and you have a $10,000 deficiency. Worst case for studs out is the unit owner has no insurance and there's a $150,000 deficiency on their unit, you know, and you've got a burnt out unit or a flooded unit that they walk away from, the unit owner does, because they don't have enough cash to fix it. So, but there's pros and cons to both sides. Earthquake coverage. So earthquake is still an issue out here in Portland because we haven't had the big one yet. We're projected to have a 9.0 something earthquake out here. We have low frequency, high severity exposure in Portland metro area for earthquake. And so earthquake has been steadily getting more expensive and more elusive for insurance companies to procure coverage for. We as a company used to offer a 2% deductible and full limits on this. In this particular case, you know, we now only offer a 15% deductible. But there's carriers out there that don't offer it at all, or, you know, have to procure a standalone company to provide earthquake insurance. So it is a big line item on your insurance cost, especially the bigger the buildings. The mid-rises, high-rises get extremely expensive to insure for this. And it's a consideration. As a board member, I recommend, well, what I see from board members is they always opt for it. So I think I've only got 2 associations out of my 500 plus that we insure that do not have earthquake insurance. And the reason for that is because if we have a giant earthquake and they don't have insurance for the earthquake coverage there, can pretty much promise you that those board members are going to get sued personally for making a poor fiduciary decision. And so, you know, just that concept of when you're making a decision by committee, generally we see associations opt for more coverage or fuller coverage than they might personally have the stomach for. So the earthquake is an interesting one. The important thing to note about earthquake is the deductible and how it works. 15% is not applied against how much damage was created by the earthquake. 15% is applied against the replacement cost of the buildings. So in this case, if we have a $30 million coverage scope for the replacement costs on all the buildings in this association, 15% times 30 million is $4.5 million. So $4.5 million deductible. And who pays for that? Since nobody answered me last time, I'll let you know. The unit owners would then pay for that through a earthquake loss assessment. So the board would turn around and divide the 100 units at 4.5 million divided by the 100 units in my fictitious association. Everybody would get a bill for $45,000 to pitch in for their portion of that. And again, unit owners can insure against that deficiency on their unit owners insurance coverage. And we'll show you that here in just a few more steps. Any questions on earthquake? All right. Building ordinance and law, quite simply, it is additional funds available to rebuild the building if your city and local ordinances step in and say, you have to tear down the rest of the building, you have to now rebuild it in a different form or fashion, such as you now need to have sprinkler systems or an elevator or wider windows. If there's any changes on that and it costs more for the insurance company to build, there's additional funds available. General liability, This is basically your bodily injury and property damage coverage. So if the association is accused of or causes bodily injury or property damage to someone or something, this example, the base policy will step in and pay up to $2 million for each occurrence for those allegations and those incidents, not to exceed $4 million aggregate, which is a fancy way of saying in a policy year. If we scroll down just a little bit to the bottom here, this association has opted for a $5 million umbrella policy. And while we're talking about general liability, umbrella policies are an extension of general liability. So with the $5 million umbrella, this $2 million per occurrence becomes $7 million per occurrence. And then this $4 million aggregate becomes $9 million total when we take into account the umbrella policy that they have. Medical payments coverage differs from liability in that you don't have to be at fault. So if I come over and visit you guys and I trip over my own clumsy shoelace and I break my hip, there would be $10,000 available for my medical payments. So it could be a first aid, ambulance ride, health insurance deductible. I like to call this one the please don't sue me coverage. It's a nice gesture by the insurance carriers before things get litigious, before my shoelace turned into an uneven sidewalk that I tripped over. Hired and non-owned auto, you should see this on all your association policies there. This extends automobile coverage to the association, even if you don't own any vehicles. If you have a board member that gets in their personal car and goes down to visit CMI to drop off a check or pick up a check, hopefully, in that case, they get in a horrific accident. And then if the attorneys find out that they were doing work on behalf of the association at the time of the accident, the association could be pulled into that allegation or that liability issue. And this will allow for the association to be defended. And then hired auto. So if you hire a landscaper or a contractor to work on the property and they get in a horrific accident while doing work for the association's policy will step in and defend the association since they were working for them at the time if they're allegedly involved. Management company extension. So with all professional management companies in town, even the bad ones, they all require that the association provides extension of liability coverage for the association. Because if you guys get sued as an association, I promise you, CMI would probably be named in that as well. And this will allow your policy to defend CMI. CMI and all the professional management companies in town should be carrying and do carry good, insurance for their general liability. So this is really specific to your property. So you're not going to be defending them for an issue that they had across town. It's really anything that's associated with your losses. Directors and officers. So your personal insurance that you carry as an individual will exclude any coverage for you acting on a board, either paid for or not paid for. And therefore the association actually has to buy a policy to protect board members, volunteers, committee members, anybody working on behalf of the association from personal lawsuits from their actions on the board. So if you deny somebody and say, hey, you can't paint your front door CMI purple, and they get mad and decide to sue you personally for discrimination or harassment or whatever they can conjure up, then this policy will step in and pay for the legal fees associated with that and any damages to protect you as a person. Crime coverage. So the associations collect money over time in the form of dues. So you're collecting dues every month or annually. That money accumulates. You need to insure against its theft. And so crime coverage, also known as employee dishonesty, also known as fidelity coverage, will cover your funds from being stolen. So if your management company gets sticky fingers and they steal your money, if your insurance agent steals your money, or if a third party in a foreign country steals your money electronically, you want to be made whole again. Sorry about that. So in this case, the 650,000 represents a formula that the Oregon Condominium Act dictates. And that formula is the amount of money in reserves plus 3 months of dues. So add everything in your accounts plus 3 months of dues, and that's your target amount at renewal every year. And you do want to review that because that number can increase over time as you guys are in accumulation phase. And then if you have some capital projects that you're working on, it can reduce quickly too. So you can reduce that figure and still be appropriately insured and save some money.
Could you just review that real quick one more time?
Yeah, I went through that fast. So, so the formula is the amount of money in reserves. So AKA everything in your bank accounts, plus 3 months of dues.
And that's the employee dishonesty.
And yeah, also, yeah, it's also known as employee dishonesty. You'll see it as a crime coverage, employee dishonesty, and that's also termed in your bylaws as fidelity coverage. So again, the crux of it is it's ensuring the association's monies from being stolen or making you whole after they are stolen. So you can see the premium packages here, the cost on that, that's just a rough number example there, but right underneath that, sometimes there's optional coverages such as workers' comp. Most associations don't have direct employees. So why in the heck would we need workers' comp? The answer is twofold. Number one, it would cover board members, volunteers, unit owners that are working on behalf of the association. So if you have a unit owner break out his ladder and just decide to crawl up the side of the building and change the light bulb above his garage because the maintenance team from CMI was, stuck at home in the snow. In that case, he falls off the ladder, hurts himself. He would have coverage as a working on behalf of the association. It wouldn't cover him for going to play in the weekend football game, but if he's doing something on the property there for the benefit of the association, he would be covered. The other facet that it covers that I'm kind of more intrigued about, or I see more often, is the association hiring a subcontractor. So let's say a landscaper is hired. CMI vets their insurance, make sure that they're appropriately insured to start work on the property. They start work, but 2 months later, the owner of that company calls and cancels their workers' comp insurance. And then they still have workers out there, and one of the workers gets hurt, cuts their finger off mowing the grass. This would be a backstop to that insurance because associations are now being deemed as the default employer. Not only the associations, but the management company as well gets drug into that and having to pay the bills. So relatively inexpensive scope of coverage there. It's about $500 a year to have that on association policy. And then down below, you'll see deductible options. We are seeing with the increase in cost of insurance and the higher expense ratio for claims, we're seeing associations opt to have a higher deductible. So instead of 10,000, they're opting for 25,000, maybe even 50,000. I've got 2 associations with $100,000 deductible. So the higher deductible, the more that the unit owner, again, is responsible for. So you're deferring the responsibility from the association and pushing more of that over to the unit owner, almost becoming a pseudo studs out insurer in a sense, because you're really forcing the unit owners affected to have that higher deductible. If you notice, the premium savings to go with a higher deductible is not significant. But what is significant is the reduction in claims for an association. So when you have a higher deductible, you have fewer claims because the smaller claims never breach the deductible and they're just handled by the unit owners' insurance companies. And by having fewer claims, it preserves the insurance premium pricing for you down the road. So you're actually insulating your insurance costs for the longer term. So that is a big value play. I'm going to quickly move into the unit owners insurance here while all of this is fresh in our mind and talk about this. And I believe a gentleman had a question in regards to what does the unit owners insurance look like on this So utilizing the scenario that we just talked about, the association being all-inclusive and the association having a $10,000 deductible, this is a unit owner's insurance policy that was specifically built around that concept. So the first coverage that you'll see here is Section 1 property coverage for coverage A dwelling. And you'll notice that the limit of insurance on that is a familiar number, and that's $10,000. Why 10,000 bucks? Rebecca knows, but she's on mute.
It's a
So
deductible.
it's the deductible, that's right. Yeah, so the association had a $10,000 deductible. Therefore, the unit owner's worst case scenario is that they would have to come out of pocket for 10 grand. Therefore, the unit owner's insurance, the most you need on your unit owner's insurance policy for coverage A dwelling, if your association has a 10 grand deductible in an all-inclusive scenario, is $10,000. We see a lot of unit owners that have $100,000 in this category, 70,000, 80,000, 150,000. It is an absolute waste of money. It is literally throwing money down the drain because their policy will never execute for anything over that $10,000 mark. The association's policy is primary. It has to execute once that deductible has been satisfied. And therefore 10,000 is the most that a unit owner would need in this example. Any questions there? All right, it's all coming together. Coverage C, personal property. Personal property is really the only question I ask a unit owner when they call our office and say, hey, I want to buy some unit owners insurance from you. You insure our association. I ask them one question: how much personal property do you want covered? The visual that I gave you where you take the condo unit, turn it upside down and give it a gentle shake, everything that fell out, in this case, that scenario is $50,000 worth of stuff that fell out. If it's, if you have beautiful furnishings that you've been handed down through the centuries from your in-laws and parents, then you might need a higher limit to replace nice furnishings or nice contents or more contents. But if you're an IKEA special guy, like me, then you might have $20,000 worth of coverage in that category. So it's really just your comfort level as a unit owner. Loss of use. Loss of use coverage is very much not paid for by the association. So if you do have a fire in the association or a pipe break and the unit owners have to move out to relocate while their unit is being repaired, the association's policy does not pay for their relocation expenses, their increased food expenditure because they have to eat out every day, or their hotel or their apartment rental. Therefore, the unit owner's insurance policy has a built-in coverage there that will pay for some of that. So, or a vast majority, depending on the limit of coverage there. So there was a couple items that we touched on, and number one was additional coverages loss assessment. You'll see loss assessment here for 50,000. That was that scenario where the roof, the roof was hit by the tree this morning from an association. It was all common elements. The association paid the $10,000 deductible. Then they turned around and did a loss assessment to all the unit owners in the association for their portion of that bill. This line item coverage here of loss assessments, what can pay for that for the unit owner. And so all HO6 condo unit owners policies come with $1,000 worth of loss assessment coverage. To increase that from 1,000 to 50,000, the annual cost is $12 a year with my company. So it's very similar with any company out there. It's very inexpensive to add loss assessment coverage. So we recommend a very high limit on that for bad scenarios. And then the other coverage that we discussed today was.
We have a question really quick, Larry.
Oh, good.
For,
I can't see
Susan
the
Clark.
hand. So Susan, yes.
You want to go ahead and unmute yourself?
Oh, I think her hand was still up from the last question, Carra.
Oh, okay.
So, yeah, and so the other thing that we discussed was that earthquake loss assessment. So in the fictitious association here. We had a $4.5 million deductible. We have 100 unit owners that are going to share in that deductible, so $45,000 a piece. In this case, that bill can be paid for by their insurance company if they have two things. Number one, do they have earthquake coverage? If they have earthquake coverage, the next question to ask the insurance agent, will it cover a loss assessment for earthquake? So when the association loss assesses that earthquake deductible back to me, will it pay for that? So some companies still offer that. There's still a good handful of companies that offer the earthquake coverage and the earthquake loss assessment, but I realize that there are a lot of companies that no longer offer that directly. Allstate, great company, been around for years, high respect for them. They do not offer earthquake internally anymore. It was after Hurricane Katrina, they stopped offering earthquake if they had an earthquake over here and another Hurricane Katrina, it could bankrupt the company as big and as strong as they are. So they said, no more earthquake. We're going to sell it through a company called GeoVera, which is a third-party company, and it can be a little expensive if you go that route, but just need to ask those questions there. A loss assessment, the one thing I wanted to add here, so loss assessment does not pay for special assessments. So if you have a roof that needs to be replaced on your association and you special assess $30,000 to each unit owner to pay for a new roof, no, their insurance policy will not pay for that special assessment for the replacement of a roof. Loss assessment is an insurance loss that is assessed. Two specific things there, but we do get that question a lot, or a lot of phone calls coming in saying, hey, I just got an assessment for new painting or new siding on the buildings here. I want to open up a claim. And unfortunately, that's kind of not something that insurance is going to cover. So take a little break from the share screen here and open this up to more questions. Hopefully
So we had one in the comments that I answered, but I'd love for you to answer, see if I'm right. How much do premiums rise every time you make a claim?
Lots. No. What did you say, Carra?
Oh goodness, what did I say? I said the premium, I meant to say premium rise would be affected based on two things, number of claims and severity.
Yep, you got it. Yeah, so the insurance company looks at two things, the severity and frequency of which an association is making claims. We expect associations to have claims, and we will actually be fairly gentle on the first claim. It gets exponentially worse as things progress. So, Linda, you want to have a comment on there, or did you have something to say there?
In 2021, we had our first claim with a
Okay.
$10,000 deductible. Our insurance paid out $41,000.
Okay.
We lost a 15% claim-free discount. So our premium essentially went up 15%,
Yes.
which was
Yeah,
a lot.
that's kind of a sneaky way of hitting it to you, right? I mean, you're getting this claims-free discount, and then you get that sucker removed. So it's almost setting you up beforehand. If you really think about it, if I've got a claims-free discount and I make a claim, that thing's going to go away. It's an automatic increase of cost there. So
Yeah, that's in addition to their annual rate increase too.
right. That's always a fun one for us insurance agents to explain is, hey, you had two claims this year and we had a rate increase, and that's why your insurance took some significant action this year. So there isn't really a good answer to the direct question of how much do they go up. It's not a set percentage. In your case, it was, Linda, because of the claims free on that. But there's kind of a sliding scale and frequency and severity. So the bigger the claims, the more action you can see, rate increase, and then the more often you have claims, even if they're tiny ones. So the idea is don't make tiny claims. We've had scenarios where I call CMI and say, hey, the bill's going to be $12,000. And you got a $10,000 deductible. Do you really want to open a claim on this? And the answer is usually no. We'll pay for the extra $2,000 out of pocket. Even though we'll certainly make that claim, and we're not advising them not to make the claim. It's just more of, hey, this is an option to kind of preserve that loss run, for future endeavor. So,
Catherine?
Yeah, just following on to that point. So if you have a 10, is there some magic number when it is worth putting a claim in? Because you said a 10,000 deductible, 12,000. No, we have a 10,000 and are looking at a 30,000. So, I mean,
yeah.
how does the board decide?
Yeah.
I think it depends on how much money you have too. If you have, $5,000 or $6,000 extra that you can maybe put towards this in order to not have an increase in your insurance, then, that might be a good decision for the board. It is a business decision and it's a hard one to make. You just kind of have to weigh the funding you have available and where you are in terms of, have you already filed 2 other claims in the last 5 years?
And the other thing is how big of, what are you paying annually for the premiums, right? I mean, if you're paying $50,000 a year, then, paying $10,000 out of pocket might not be a bad idea. But if you're paying $5,000 a year because you're a tiny association, make the claim, because even if your insurance doubles, it's still not gonna, it's still not going to do that. So that's more of a discussion, I think, on a case by case to talk to your insurance agent about, your manager about, and have that discussion. And you should never be pressed into not making a claim. When you have the right to make a claim, you can absolutely make the claim. But it's really just kind of, my premise on insurance is it's kind of like going to Vegas. If you're going to go to Vegas and gamble, the dealer is going to win, which is the insurance company. So the more that you don't gamble, the more you can self-insure by not gambling is basically a winner for you guys within reason, right? You can't self-insure for liability, but there's some, interesting concepts just to think about that and get some good advice from your professional on that. And then it looks like Emerson had a really good question. What happens if it ends up costing more to rebuild the building, like after an earthquake, than you have coverage for? Really good question. So for the standard perils, such as fire, wind, water, hail, vandalism, explosion, riots, all those kind of things that are under standard perils, things that could happen to the property, that's where that guaranteed replacement cost comes in really nicely. So we don't see, any issue with that if it's over that. But if it does come to earthquake, our policy, our classic policy that we've offered for years has earthquake guaranteed replacement costs, which means that if we got you insured for 30 million and it costs us 50 million because everybody needs to get their stuff rebuilt and materials and labor are skyrocketed, we're going to spend the 50 million. At the end of next year, we're no longer going to have any of those policies in force. They'll all be reverted to a scenario where we've got just the limit of insurance on the earthquake. So if you do have that scenario where it costs more to rebuild, so you have $30 million worth of coverage and you have a $40 million loss, that $10 million deficiency would then be assessed back in the form of a earthquake loss assessment and paid for by the unit owners there. Oftentimes insurance carriers will work with you though and say, hey, we've got $30 million of coverage, you're $10 million shy. We're just going to cut you a check for the 30 million and we're going to be out the door. You then have an option as a board to say, hey guys, do we want to rebuild? Or does everybody want to take their snippet of the 30 million and walk out? If there's 100 unit owners, everybody gets a check for 300,000. The association sells the land, divvies up the proceeds from the land, and then we all move on to a different location. So there's different options, and you can spend hours discussing Blue Buffalo scenarios, but just kind of having that idea of the earthquake will have a limit to it eventually, and what's not paid for by insurance is paid for by unit owners. So I think that's all the questions. Yeah, I think we nailed up most of the questions there, unless anybody else have anything there? One new message. All right, thanks, Emerson. Appreciate you guys. Carra, did I miss anything? Any hot topics? I think we covered most of the painful items, right?
Right, yeah, no, I don't have anything else for us. So if there are any further questions, thank you all for coming, and we hope to see you at our next one, which is going to be on parliamentary procedures, and it will be June 2nd.
Before
June
you
2nd.
go,
Oh, yes. Hi, Beth.
I don't know how to put my hand up on this. Is my first Zoom, so
Welcome.
the question, thank you. What's the question? I'm sorry. If the insurance does not cover the damage and the association decides to take a vote and the majority says move on, then that's not an opportunity for the ones that want to stay and rebuild, is it? They have to move on too.
Yeah, I'm sure there's quite a lot of legal endeavors in that there'd be an attorney involved. So I can't advise you too far down that road, but I'm just saying that the associations, with most insurance companies, they're not just going to say, hey, you have to rebuild and you're $10 million shy and we all have to come up with X amount of dollars out of the pocket. There's certainly going to be different avenues that you can explore. Financing, there's going to be financing, walk away, assessments. So yeah, I think there's going to be a lot of details on that one. So I probably wouldn't speculate too many without getting one of the professional attorneys involved. But even that's kind of like they have to make a determination at the time that it happens and figure out all the details behind all the actions there. So.
Thank you.
Thank you.
Thank you, Larry. Good session, Carra. Very nice.
Thank you.
Thank you. Can I come to the parliamentary procedure one? Because
Of course you
thought
can.
insurance is usually the driest subject, but that one might win. So
We have Rich Vile coming too. So we
he's
have,
he's actually
it'll be real fun. I'm actually really excited about it.
awesome.
So yeah, but it's June 2nd, and we'll send out more information as we get closer.
Very cool. Well, thank you very much for having me, guys. I
Thank you,
appreciate all
Larry.
of you. And again, if you need us, always give us a shout. We're happy to help you. If you're not our client, we're still happy to help you. So thank you very much and have a great evening.
Thanks.
Bye. Thanks, everyone.
Carra, do those invitations for these trainings, do they go to all board members or just the board chairs?
They should